Joining me now with more on the economy and its outlook is Mark Zandi. He's chief economist at Moody's. Mark, it's great to have you on the show this morning with so much to talk about. How does the economy look to you?
Good. It's growing strongly, creating a lot of jobs. Unemployment is low. You know better than I. The stock market is flirting with record highs on a daily basis. The one blemish has been inflation, and while that's come in, it's still above the Federal Reserve's target. But broadly speaking, the economy is performing well.
So the latest results from Walmart this morning, making the note of tariffs. Of course, we've seen this new administration say that there will be double-digit tariffs on a variety of countries. How does that factor into the outlook?
Well, that's a problem. I think broad-based tariffs, like the kind of tariffs the president's been talking about, reciprocal tariffs would be an example of that, are bad for the economy, unambiguously bad. It raises inflation. By definition, it raises prices on the things that are facing the higher tariffs. And in a world of high inflation expectations, fragile inflation expectations, there is a risk that higher tariffs are not just a one-off hit to prices, that they result in higher inflation going forward. And they hit growth. Other countries are going to respond, especially if these are broad-based tariffs and will be in place for a while. Other countries will respond with their own tariffs, other trade restrictions. That'll cost American jobs. So, higher cost of living, fewer jobs, that's not good.
So tomorrow on Friday, we'll get the latest consumer sentiment read. It does follow a read just recently that did show consumers anticipate inflation do be higher this year by almost a full percentage point. In fact, above 4%. Do you think that's an accurate target?
Well, that's the University of Michigan survey. It's got some issues. Everyone's who responds to the survey looks at it through their own political prism. So Republicans view things differently than Democrats. So we've got to take it with a bit of salt. But it's making a case. Clearly consumers are very focused on inflation and prices. They've been through a lot over the last 3 years. They're very sensitive to any hint that prices are going up. You can see what the reaction has been to the higher egg prices, for example. So, yeah, I suspect consumers are on edge, nervous about the higher prices. Maybe not to the degree the University of Michigan survey says, but regardless, I think they're nervous about it and worried about it. And again, another reason to be nervous that the higher tariffs aren't just a one-off. Will have a one-off impact on prices. It might have a broader, longer-term impact on inflation.
Mark, what is your expectation for inflation this year, and how does that impact the Fed's path forward on rates?
Yeah, before the tariffs, I thought maybe we get back to the Fed's target of 2%, sometime this spring. Now I think that's not going to happen. It feels like we've seen the end of the so-called disinflation, the slowing in inflation. That's over. Inflation is still, it's within spitting distance of the Fed target, but it's not there. And so now I expect that we're not going to get there in 2025, maybe not until 26 or 27. If that's the case, then yeah, I think it means that's one more reason why the Fed's not going to be cutting interest rates anytime soon. They're going to be on hold here. The other big reason, of course, is just the uncertainty around economic policy. Exactly what does the president have in mind with regard to the tariffs or immigration policy? And then you've got the Treasury debt limit battle that's looming and tax spending policy. There's a whole slew of economic policy that's in train here, and until there's some clarity around that, it's hard to see the Fed cutting rates.
So in terms of where we go from here, we had seen the retail sales data for January recently impacted by factors like the weather, like the wildfires, for instance, the flu season as well. Do you see some of those headwinds dissipating in the month of February?
It just feels like the economy is throttling back here. So some months a little bit better, some months a little bit weaker. Obviously January was a tough month. Maybe February's better, I'm not sure. But it just feels like the trend lines here suggest slower growth. And the economic policy that we're going to be struggling with here will ensure weaker economic growth going forward. I don't think it's enough to push this strong economy into recession. And I do think the president, the administration will be sensitive to any sign that the economy is weakening and will pivot on their policies if they need to. But I do think we've got a weaker economy dead ahead.
So the S&P Closing at another record yesterday, fractional losses today, tariff concerns certainly out there. Mark, we had talked about valuations. You brought that up earlier in this segment. What does all of this mean for stocks and investors going forward?
Well, I always hesitate talking about the stock market. I get asked that question obviously a lot from friends and family, and I always say, hey, look, you're invested for the long run, so you should kind of look through any ups and downs and all arounds. But, here we are. And as you said, valuations are awfully high. It feels like a lot of good news is priced in already. Given the economic policy deadhead, given what I just said about the Fed and what I just said about economic growth, it feels like you got to be cautious and that the equity market is going to have a bit of a struggle here, at least for the next few months, next few quarters.
Mark Zandi, he's a chief economist at Moody's. Mark, great to have you remotely. Hopefully you can join us sometime in studio. We appreciate it.
Yeah, take care.
Thank you.